I started my working career at the Harris Bank as a foreign exchange trader. I then went to New York and was a bond trader at a failing firm, Blythe Eastman Dillon. Our firm was taken over by Paine Webber in December of '79. There was a get-together cocktail party for the people in fixed income at Blythe Eastman to meet the people at Paine Webber. At that cocktail party, I met at the bar a Bill Dudley. He heard what my background was, and he invited me to transfer out to Chicago, and he would give me a salary, a decent salary, and he'd give me a firm seat, and I would be an analyst before the open, after the close, and during the day when needed, but that I would be able to trade my own account when my services weren't required. And he estimated that in a 6-hour working day, I would have 3 hours to trade. And he also told me that he would help me to forget everything I learned in New York, and that he would teach me how to trade Chicago style and how to turn the edge into money. Well, it took a while. I came to Chicago in December of '79. I stayed with Paine Webber for a year and a half, but the financial futures growth was so incredible that Bill did teach me how to trade Chicago style. He taught me with the help of Everett Clip. They gave me simple rules to follow. I followed them. I was a successful small local, but the business, Paine Webber's business, was growing so rapidly that the thing he didn't deliver on was I didn't get 3 hours a day in the pit. And it wound up being 2 hours, 1 hour, and then no time at all. And he paid me a lot of money, but I wasn't getting a chance to trade. So I moved to Kidder Peabody, and they said they would give me the deal that I originally had and that I would be able to stay in the pit. And then their business grew so quickly that I had no time in the pit. But I did become a partner at Kidder Peabody, and I made a lot of money, and I made more money than I thought I could make as an independent. And I stayed at Kidder for 7 years and made partner, saved my money, and then I resigned. And I said I was going to seek my fortune in something other than Wall Street, being with a Wall Street firm. Matt started the brokerage business, and it immediately became very successful. He had more business that he can handle, and he invited me to join him within 2 months of starting the business. That's how I wound up in second month. It was as a broker with my brother Matt. I'd gotten an MBA at the University of Chicago. I had been indoctrinated in the efficient market hypothesis. Now, working for the edge, like Bill Dudley taught me to do, get the edge, cut your losers, ride your winners, turn the bid-ask spread into money. That was consistent with the efficient market hypothesis, that you don't have to be right the market. You can be right less than 50% of the time and be the most successful local in the pit. The conflict that arose when I became a broker is that my brother Matt said, well, these spreads, the time spreads, they go down in price as you come into first intention day, because the longs cannot take a chance on taking delivery. And so the longs have to roll their position first, sell the front month, and buy the deferred month. And a lot of the shorts, by law, are only allowed to be in the contract with the most open interest. So this is real easy. The longs roll first, they sell the front month, buy the deferred, so you sell ahead of them. And then right when you're near first intention day, you reverse your position, buy the front month, sell the back month, and then the shorts will come in to roll their shorts, to roll their positions, and you ride it back up. And I was the economist who said, well, Matt, that's ridiculous, because, if you're telling me that, then everyone knows that, and you can't there's just no money to be made there. The market's efficient, and this is not going to work in the long run. And so I looked at it my first quarter, I looked at my second quarter, and I looked at it my third quarter, and we're making money as brokers. And it wound up happening every quarter. And so that was a conflict that I had to resolve, that the market wasn't efficient, and that flows in commodities are so big that there are times of inefficiencies. The hedge on May 1997, the day of there was a Fed meeting. There was a 50% chance that the Fed was going to raise the Fed funds rate. And by this time, my brother and I had been taking full advantage of the knowledge that we had gotten from Bob Heine that gave us knowledge that other people in the pit didn't have, and the faster speed and cheaper cost that the guys upstairs had. Bottom line is, we had the biggest position we ever had. We were short 30,000 bond spreads. It was a big part of the open interest. We were short 30,000 June bonds. We were long 30,000 SEP bonds. The position was 3 times bigger. The biggest position we had had prior to that was 10,000 time spreads. So it's the biggest position we had had. And the clearing firm, our clearing firm, had put a margin call on us. And my brother was out of money, and I brought in my last cash and put it with our clearing firm to hold the position. And we had to decide whether we were going to hold this thing over the Fed number. And we felt pretty confident that it was a good position and there was more money in it. We're talking about it. My brother and I are both in the pit, and he comes over to me and he says, "Look, you're looking nervous. Everybody's looking at you. You leave the pit and let me take care of this." And hey, we had enough money to cover the risk in the position, but if it had gone badly against us, we would have lost all the money that we had made trading over the last, several years of starting out with hundreds, thousands, bigger and bigger. And so there was a catwalk. This is the new Board of Trade floor. And I went up to the catwalk. I walked around, and I had an hour to go. And I thought, life is going to be really different at 117. At 115, it came out that the Fed didn't raise the Fed funds rate. They didn't raise the discount rate. And so immediately, euros start going up. I'm thinking, wow, well, that's good. That's 850,000. Now, what's going on with bonds? We're short 500. So the bond part of the hedge is short 500. And bonds are going up too. And I'm trying to do the math in my head. I'm trying to figure out, am I making money or losing money? Hey, I think we're making money. And what's going on with the spreads? 12-13, it's not trading. And then all of a sudden, bonds stop going up and they start going down. And bonds go down on the day. And so we have $850,000 in the long 3,300 euros, and bonds are in a fast market going down. And it's like, wow, we're up over $1 million. And I'm thinking, well, Matt is probably going to buy the 13s, take the trade off, and we make $1 million on the day. And I look down, and Matt goes, and Matt says, "Listen up, sell it at 12. And then the spread starts trading at 12, and we didn't get the whole position off there, but we got off tens of thousands of them, and it was near a $2 million day, and that was a lot of money for us at the time. We go into 98, and we have first quarter of 98 doing the same sorts of trades. We had our best quarter ever. And then we came into the third quarter of 1998. We had a big bond spread position on. We were short the first spread. We were short the June, long the SEP, short the Ds. The total number of contracts there was 110,000 bond contracts that we had on. Open interest was about 1,150,000 at the time, and so it was a big chunk of it, and it worked out well. A little pregnant moment, but it worked out well, and we were feeling really cocky. I mean, we think that we're the best. Okay, this has been going on this is the sixth quarter of trading these just stupid. They were stupid numbers. Okay, and so the first trade, we got in and out of the bond spread and trading the front from the short side. And the position we put on started to accumulate. We're pretty much out of the bond spread position, and we started to buy the 10-year spread. That's buying the SEP 10-year notes, selling the Ds. And that was the time when the long-term capital thing was starting to unravel. And there was a chance of an early delivery in the 5-year spread. And, we know all about early deliveries. And, we got a little sloppy, and we didn't think there'd be a delivery. And if there was a delivery, our positions were so new that we thought we wouldn't get hit. But what we didn't consider is if there was a big enough up move and there was a delivery in the 5-year, that could spook the longs to more aggressively sell the ones that were left. And bottom line, we lost $1 million a day for like 5 days there, and it took out a big chunk of what we had made that year. And then the night, I'm pretty sure it was the night of August 30th, there wasn't a real developed night market. We're long SEP and we're short Ds, and what we're long is only offered, and what we're short is only bid. And I saw that, and I freaked out, and certainly couldn't get out at night. It was midnight. That was the worst night I ever had, and I went in the next morning, and the spread was trading at a discount, meaning that it was trading minus 13.5, minus 13. That means that the front month was 13.5 ticks bid under Ds, and it was 13 ticks offered. And I was the clearing firm didn't call me, but I was worried about a call, and I said, look, Dennis, just want to let you know we're going to bring this 5-year position down today. Okay, I've had enough of this. And he said, oh, okay, fine. So they weren't as worried as I was, but maybe they didn't see the prices the night before. And I think settlement was around 13.5, 13. I was afraid to go in the pit and start selling. And so I called Richie Goldblatt at R.J. O'Brien. We had a give-up agreement. I got on a phone where nobody could hear me, where I could see the pit. I said, Richie, this is Gary. I got some spreads to do in the 5-year. And he said, fine. I said, get me a market. I was there right. I said, get me a market on the open. He said, it's opening up 13.5, 13. I said, sell 500 at 13.5. He said, you're filled at 13. I said, great, that's half a tick better. And I said, sell another 500 at 13.5. I'm trying to hit the bid. He said, you're filled at 13, getting filled on the offer. Kind of unusual. And I said, sell 1,000 at 13.5. He said, you're filled at 13. I said, who's on the other side? He said, J.P. Morgan. Sell 5,000 at 13.5. He said, you're filled at 13. And so I'm kind of adding up. I'm out of half the position at this point. And it's like, okay, J.P. Morgan's a buyer. And I had to decide. I said, this is probably the low. And I had to decide, hey, there were partners involved, but I was the only one at this point with with extra money, and I had to decide. I liquidated the position right there, and hey, what's the lesson there? Well, one, it was hubris. It was sloppy. It's like, we were really too full of ourselves. It's dangerous. I mean, we were doing these huge trades for 6 quarters and everything was working. There's a danger in that. There's a danger in thinking that you can fly without wires. From that point on, we never had a position that big again. There'd be 5 of us, and we'd go through a movie and try to recite all the lines of the movie. Caddyshack was a favorite. The Godfather was a favorite. And there were a bunch of people in the pit that had great memories and watched a lot of movies. And that was good. That was good, good, clean fun. There was this guy, Jay Zimmerman, at the Merc. And he was a broker. And one day this guy goes to bid and he says, quarter bid for 50, quarter bid for 50. And Jay said, don't put your arm in my face. The guy goes, look at him, says, quarter bid for 50. Jay says, don't do that again. Goes, quarter bid for 50. And Jay went and bit his arm and drew blood. And it's like, wow, what is this? And they call the security guards over and they take him out, and everybody's saying, wow, fighting, as fights would happen. It's really, that was treated seriously. Those were big fights. I mean, if you just yell and scream or push somebody, but if you actually start punching, which sometimes happens, that is treated, that's a big fine. That's a $10,000 fine, was my recollection. They take Jay out of the pit, they write him up, and they say, well, what is this? This could be huge. I mean, a human bite is, that's got to be more than being punched out. They charged him $50 for eating in the pit. All those years ago, it wasn't just 100,000 floor traders. There were a couple of 100,000 traders off the floor that made really good livings. And now you have a handful of firms. There's anybody that wanted to be as fast as us I was faster than we were faster than the people upstairs, but anybody could lease a seat, go in, stand next to me, and they could be just as fast as me and just as cheap as me. They had the opportunity to do it, and it was a pretty small entry cost. It was, put $25,000 in a trading account and lease a seat. But now, to compete on speed, it costs tens of millions of dollars a year. And in my view, in terms of that bid-ask spread, not only the bid-ask spread, but also to be lifting offers when relationships change. These trades that we did, there'd be 13 different contracts involved in them. And to be speed competitive on the trades that we did, it takes tens of millions of dollars. And in my opinion, there's only 20 people in the world that are trying to be competitive to be able to be competitive on speed and take edge out of the marketplace, take the bid-ask spread, if you will. And I think that there's 5 of them that are getting almost all of it. And, that's sad that there's so few people getting what 300,000 people got before. But the other thing is it's really dangerous, because if those 5 people, when we dropped our hands, when we got scared a couple of times, there were other people to pick up the sword and charge the line. And that's not the case today. And I think it's really dangerous. And I think we had that flash crash in 10. And I think that there's going to be some really nasty events where those 5 guys drop their hands, and there's going to be dire consequences. Of course, I'm sad because I enjoyed it. I made great friendships and made a lot of money. But I think there's also a danger to the system to replacing 300,000 people with 20.